Just a few months ago, NVIDIA looked unstoppable. Investors were calling it the most important company in the world. Wall Street analysts couldn't stop raising price targets. Retail traders were pouring money into AI stocks at record speed, convinced that artificial intelligence was about to create a new generation of trillionaires. But then something changed. Suddenly, the market started shaking. Tech stocks became volatile overnight. Investors began questioning whether AI valuations had gone too far. And now, many people are asking one terrifying question. Did NVIDIA just trigger the beginning of a massive market panic? To understand why this matters so much, you first need to understand what NVIDIA represents right now inside the American economy. NVIDIA is no longer viewed as just another semiconductor company. It has become the face of the entire AI revolution. Its chips power artificial intelligence systems, massive data centers, advanced cloud computing, and some of the biggest technology projects on Earth. Companies like Microsoft, Amazon, Meta, and Google are spending billions trying to dominate the AI race, and NVIDIA has been sitting directly at the center of all of it. That's why investors became obsessed with the stock. Over the past 2 years, NVIDIA's market value exploded at a speed Wall Street rarely sees. Millions of Americans watched the company become one of the most valuable businesses in history almost overnight. The stock market started behaving as if AI growth would continue forever. Every earnings report became a major national event. Traders treated NVIDIA almost like a cheat code for easy money. If NVIDIA went up, the entire AI sector usually followed. But when one company becomes this important to the overall market, the risks become much larger than most people realize. Today, many investors are behaving as if artificial intelligence guarantees unlimited future profits no matter how expensive AI stocks become. Companies with minimal earnings are suddenly worth billions simply because they mention AI in presentations or earnings calls. Retail investors are chasing momentum out of fear of missing out. Social media is flooded with predictions that AI will create a new generation of trillionaires. Financial influencers are treating AI stocks like a guaranteed path to wealth. What makes this situation even more dangerous is how concentrated the modern stock market has become. A small number of giant technology companies now control a massive percentage of the S&P 500 and Nasdaq. That means millions of Americans with retirement savings tied to 401ks, IRAs, pension funds, and index funds are heavily exposed to the success of AI-related companies whether they realize it or not. At the same time, the broader American economy is already under pressure. Inflation remains a concern. Interest rates are still elevated. Credit card debt has reached record highs. Mortgage payments have become unaffordable for many families. Student loan repayments are creating additional financial stress. Americans are already feeling squeezed financially before any major market crash has even happened. Another major warning sign is the speed of the current AI rally. Historically, when asset prices rise too quickly, markets become unstable. Investors stop focusing on valuations and start focusing only on momentum. That psychology creates dangerous conditions because expectations eventually become impossible to satisfy. AI companies are now expected to deliver nearly perfect growth forever. But no company can maintain explosive growth endlessly without eventually facing pressure. We're already starting to see signs of growing anxiety inside the market. Analysts are debating whether AI valuations have become overheated. Hedge funds are quietly reducing exposure to certain technology stocks. Some institutional investors are increasing cash positions while retail traders continue aggressively buying the dip. History shows us that bubbles rarely collapse slowly. But here's the important part many people misunderstand. A financial bubble crashing does not mean the technology itself is worthless. Artificial intelligence may absolutely change the future of healthcare, cybersecurity, finance, education, and business. But there's a massive difference between believing in technology and blindly believing every investment connected to it will rise forever. History teaches us that whenever investors become convinced a market can only move in one direction, danger is usually much closer than it appears. Right now, Wall Street is operating on extreme optimism. Investors are betting that AI will continue growing at a pace the market has never seen before. But when expectations become too extreme, markets become fragile. And the bigger the bubble grows, the more dangerous the consequences become if sentiment suddenly changes. That's why comparisons to 2008 are becoming more common. Not because AI is identical to the housing market, but because the emotional psychology driving investor behavior looks increasingly familiar. For everyday Americans, this moment should serve as a serious reminder about the importance of risk management and financial discipline. Chasing hype without understanding valuation, cash flow, debt levels, or long-term sustainability can destroy wealth faster than most people expect. Smart investors focus on diversification, patience, and realistic expectations instead of emotional excitement. Because when fear and greed take over Wall Street, the people who stay calm are usually the ones who survive. So, is the AI bubble really bigger than 2008? The truth is, nobody knows for certain. Artificial intelligence could continue reshaping the global economy for decades to come. But history teaches us that whenever investors become convinced a market can only move in one direction, danger is usually much closer than it appears. And if today's AI boom eventually turns into tomorrow's financial crash, the consequences could become one of the biggest economic stories America has seen in generations.